Hello and welcome back to Real Clear Investing YouTube channel, where we talk stocks, companies, and investing in general. Recently, Zillow has made headlines with its spectacular failure in house flipping business. Now that it has exited house flipping, let's walk through investment checklist to determine if Zillow stock is a good investment. Let's get it started. Zillow has three classes of shares, A, B, and C, which is a red flag in itself, as well-performing companies tend to have a single class of shares that ensures a system of checks and balances on management and founders of the company. Here, the system is broken to the detriment of average shareholder. Let's look at it. Class B shares are owned by the founders, who got 10 votes per share, resulting in a majority voting power and effective control over the company. The rest of the shareholders are there just for the ride. Well, at least Class A shares, ticker ZG, gets 1 vote per share and enjoys minority of the voting power. The worst is Class C, ticker Z, which gets 0 votes despite providing majority of the capital of the company. If you own shares of Zillow, most likely you own ticker Z, and that's where you are in the shareholding structure. As you can see, this is extremely unfriendly shareholding structure for everyone except for the founders. Obviously, founders take advantage of this situation to their benefit, and we will look next how they do it. There is a perpetual dilution of Class C shares that is not happening to Class A or B. First, there is a straightforward dilution by issuing common stock as they did in 2020 and in 2021. However, there is a stealth dilution that is done by two ways. First, by issuing convertible debt and then converting into equity. And the second way is by issuing stock options and restricted stock units. So as you can see, company issued 4.7 million of Class C shares in July of 2021 by converting convertible debt into equity. Then there are 2 more tranches of convertible debt that are eligible for conversion in 2022 at the strike price of $43.51, which is deep in the money given the current share price in the middle of 60s. That creates significant incentive for the holders of convertible debt to convert into Class C shares. So we estimate that will produce 20.1 million of shares of Class C. We also think there will be another 15.3 million of Class C shares from stock options and RSUs in 2022. Finally, there is more stealth dilution that's coming in 2023, and we estimate that number will be 26.1 million of shares. As you can see, there is a significant supply of Class C shares coming that puts downward pressure on the performance of Class C or ticker Z stock. Let's compare Class C shareholder dilution versus announced share buybacks. As you can see, there is 35.4 million of new Class C shares coming in 2022 from convertible debt and stock options, versus only 7 million of remaining announced share buybacks. Share buybacks are definitely not enough to offset new share issuance, and we expect that this situation will produce net increase of 28.4 million of new Class C shares in 2022. As a result, we estimate that Zillow will finish 2022 with approximately 279.1 million of Class C shares. After reviewing corporate governance at Zillow together, we hope you're coming to the same conclusion. It's a big no. Let's analyze Zillow's balance sheet, and let's start with their cash position. You can see here that they accumulated 2.6 billion of cash and also $500 million of short-term investments, which is essentially cash. So in total, they have 3.1 billion of cash, we can say. Now let's look at their liabilities and specifically debt. So if we look at their current liabilities, we see that they accumulated 2.3 billion of debt on the revolving credit facility. You can think of it as a credit card for the company. And then they also have 1.2 billion of securitized term loans. So in total, this is 3.5 billion. This is Zillow offers that, and that's why it's actually listed under current liabilities. It means that it will be gone, probably will be gone in Q1 when they sell the houses that Zillow offers still owns, and the houses are reflected here as 3.9 billion. So you can see that the value of the houses is higher than the value of the loans, even though probably this value is probably slightly inflated. But for all intents and purposes for the future, this inventory will be gone, and this debt will be gone without affecting cash. Now let's move to their long-term liabilities. And here we see that they have 1.3 billion of convertible debt, out of which we know that they have two tranches that will be converted into equity. So again, they will not use cash to pay off this debt, and it most likely will trickle down into equity. Most of it will happen in 2022. Part of it will happen in 2023. So essentially, they have strong position in terms of cash, and the debt will be gone in 2022 and probably 2023. Now let's look at their equity section of their balance sheet, and specifically two lines: additional paid-in capital. We can see that it's been growing all the time, which means that the company was issuing common stock and or convertible debt to raise the capital. And the reason why they were doing it, we can see it in the accumulated deficit line, which means, and it was growing as well all the time. That really means that the company was losing money, and then to offset those losses, it was issuing capital. So as a result, as you can see, that Zillow grew its cash pile not in an organic way, but actually by issuing capital, which is kind of artificial and fabricated way. At the same time, while it was done for wrong reasons, going forward, situation at Zillow will change as they get rid of Zillow offers, and they will be able to generate profit. So this will not longer happen, and that actually will go into reverse, and they will start generating profit, and they will eventually have a retained earnings line, which they don't have right now. So they will inherit this big pile of cash that potentially they can use for share buybacks. And so overall, it looks very positive going forward. That's a summary on the balance sheet position. As a summary, we would like to say that the balance sheet is strong going forward, even though the strength was fabricated in the past, but it does look like it's going to be real in the future. So that's a very clear positive. Let's look at Zillow investor presentation to understand founder strategy after exit from house flipping business. So as you can see, they still present Zillow as a growth company in a growth industry. Zillow management is still presenting the same opportunity set that they were presenting when building Zillow offers, which tells us that they have not learned lessons from the Zillow offers demise, where they try to grow company by extracting value from the home buyers, as opposed to creating value for home buyers and keeping portion of it for themselves. Zillow management decided to switch from Zillow offers to Housing Super app as a tool to extract value from its customers. Let's look just at one item, mortgages, to assess if it's even realistic. Let's look at Zillow's mortgage origination business to see if the claims about $9,000 for mortgages are realistic.
If you look at it, they've been in this business for past 4 years, and they were never successful turning profit in this business, with the exception of 3 quarters out of 16. Cumulatively, they lost $100 million in this business. This creates significant doubts that that's the business that they can run successfully. Now let's go back to presentation to continue assessing management strategy. After we looked at their mortgage origination business, we hope you understand why we're skeptical about this $9,000 in mortgages, and the same way we're skeptical about buyer referrals, seller services, and the closing services. Now let's move to the next claim that the management is making, specifically that the company can grow to $5 billion in revenue by 2025. That really means that the company needs to grow every single year 24%. Is that realistic? We don't think it's a realistic claim, and now let's look why. Let's look at every single line of business to assess if their claim about 24% growth is realistic. So they have premier agent business, which is good business, and it's the largest portion of their revenue, but it grows at 16%, and we believe it's growing actually at 10 to 14%, and with a slowdown to all the way to 8 and 6%. So it's definitely slowing business. Then they have rentals business, which is great business. It meets criteria of 24%, but it's small portion in overall 2.2 billion of revenue. Then they have mortgages business, but we just looked at it. It's money losing operation, and even though it grows very fast, but they better not grow it, or they will turn it into Zillow offers to zero. And then there is the rest of Zillow.com business, which, as we can see, A, it's small, B, it's not growing as fast. So as a result, we don't believe in their claim that they can grow to 5 billion by 2025, and the growth on the overall business more in a range of 10 to 14% going forward, and even slowing down to 8 to 6% potentially, depending on the market circumstances. As a summary, Zillow's management doesn't have value creative strategy, as a result resorting to value extraction. For that reason, we give big no on strategy. Now let's move to operating metrics. Let's look at operational metric unique users for all three competitors. Redfin, which holds third place in the real estate advertising marketplace, then Realtor.com, which holds number 2, and Zillow.com, which is the leader. They all use unique users as a key metric. Let's step back to understand why it's important. First, unique users is a key to revenue generation for each of these companies. Second, trend in unique users is a good predictor of a future trends in revenue. Now let's look how a unique users metric drives revenue. Below, we see a formula for revenue, which is very simple: price times quantity, and where quantity is driven by unique users. The way it happens is as follows. Each company tries to convert as many unique users as possible into home buyers. Home buyers then pay fees to realtors, and then realtors paying fees to each of these companies. So now you understand why this metric is extremely important. It's being monitored by all of these companies, and why we need to follow this metric. Now let's move to looking at actual trends. Well, we'll start with Redfin and look at the year-on-year growth in its unique users in order to eliminate seasonalities that can be clearly seen in the data. We see that there is a significant slowdown in activity in the second half of 2021 relatively to the first half of 2021, with small decline in Q3 21 and small growth in Q4 21. Now we're going to move to Zillow.com, as Realtor.com is private and does not publish data to make a meaningful analysis. We see more worsened situation at Zillow, where there is not just slowdown, but outright decline in year-on-year growth of unique users. Based on the analysis of unique users' activity, we see significant slowdown in the housing market that affects all three major players. However, Zillow is affected disproportionately more negatively, which is a sign of internal weakness. Now let's compare market share of Zillow and Redfin and see how it changes over time. We see that Zillow is slowly losing its market share from 87% in 18 to 82% in 21, while Redfin is growing its market share from 13 to 18% in 2021. That's another negative data point for Zillow. As a conclusion, Zillow's stock market position is under threat based on our analysis, where we saw decline in unique visitors to its website and decline in its market share. Let's look now at Zillow's growth and profitability after exit from Zillow offers. Let's look at Zillow growth and profitability after exit from home buying business. Zillow will completely exit its biggest money-losing component, Zillow offers, in Q1 2022, and will turn profitable in Q2. Profitable growth should create strong upside for Zillow stock. We have created 4 scenarios to analyze future upside potential. Scenarios 1 and 2 are more rosy and are less likely, based on our analysis of founder strategy, as it looks like they don't plan to get rid of mortgage business. Scenarios 3 and 4 are more realistic. They assume that Zillow keeps its mortgage business, which is small-scale, money-losing operation. In addition, we have created 2 different revenue growth scenarios. One is 14% revenue growth, which is more in line with what management is expecting, and then 6% revenue growth, which is more in line with operational trends we have just analyzed. The key component here is EPS, which is earnings per share, that we will use later to derive the range of possible scenarios for Zillow stock price. As a cautionary note, we would like to stress that these scenarios serve just as guidelines, and the key point here is that EPS will switch from deeply negative to strongly positive somewhere under $2 per share. As a summary, turning strongly profitable in Q2 2022 is the most positive development for Zillow stock price performance. The market expects that Zillow offers is a thing of the past. Zillow will finish cleaning up its mess in Q1 2022, and there is profitable growth in the future. Now let's look at macro environment. Rising interest rates is a clear macroeconomic headwind that Zillow is facing. First, let's discuss Treasury yield curve on the left. We see that yields are rising across the curve, and of a special concern is a rise in yield for 10-year Treasury. This will put pressure on the stock valuations, especially tech stocks. Specifically, PE multiples will compress, or in simple language, will go down. Second, rising mortgage rates don't have clear-cut negative effect on Zillow. Reduction in home prices caused by rising mortgage rates will increase number of transactions in the market, which in turn will increase need for real estate advertising, and that will increase Q side of the revenue equation for Zillow. On the other negative side, it will affect price of the revenue equation, leading to smaller fees per transaction paid to Zillow by realtors. In summary, situation with valuation is more concerning, as we believe that PE multiples will compress if rates continue rising. This may negatively affect Zillow share price. Let's go over investment checklist to see where we stand right now with Zillow stock analysis. Let's start with the positives. The strongest positive is a turnaround from a money-losing business thanks to Zillow offers, to a profitable one sometime in Q2 2022, which should drive stock price higher. The second positive is a strong balance sheet, even though it's been fabricated in the past, but it will be real in the future. There are a lot of negatives at the same time. First of all is a broken corporate governance system where founders take advantage of Class C shareholders. Second, no clear value creative strategy that could lead to strong growth. Third, operating metrics are deteriorating. And finally, companies facing macroeconomic headwind in terms of rising interest rates. Now let's look at possible ranges for Zillow stock price.
We have built valuation matrix, in other words, different scenarios for Zillow stock price, depending on future earnings per share and PE multiples. These scenarios are just guidelines. They're not calls to action, but information that can be used for your own analysis. Our base case scenario is the one with EPS of $1.94. We know it's not going to be exactly $1.94, but somewhere below $2 and above $1.50. PE multiples can also vary depending on macro environment and Zillow growth. In the first scenario, if interest rates rise, we expect PE multiple to compress to 30-35 times, which translates into stock price of $55 to $60 per share, leaving no upside from where it trades now. In the second scenario, we assume that interest rates don't rise from where they are right now, and therefore multiples don't compress. We also assume 6% revenue growth. That gives us a share price estimate of $75 to $80 per share. Finally, in the third scenario, we again assume that interest rates don't rise, but company grows in the mid to low teens range. That gives us estimated share price of $95 to $105. Generally, in case of Zillow, higher growth translates to about $5 per share up to $10 per share. If you would like to discuss more scenarios, please leave comments below. As a summary, Zillow stock upside is highly dependent on macroeconomic environment, and specifically interest rates not rising more. As a conclusion, Zillow is towards the end of its shelf life as a growth stock, and for that reason, it's not a long-term play that can be left on autopilot. There is, though, a potential short-term upside opportunity related to Zillow turning profitable. At the same time, there are many clouds on the horizon. Rising interest rates, challenging competitive environment that leads to deteriorating operating metrics, and also hostile founders and the management. This video is not an investment, legal, tax, or other advice. This video is provided for educational and informational purposes only. This video is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. The opinions expressed are those of the author. The author has no position or intention to initiate any position in the stock mentioned in this video.